Yeah, very good afternoon. Am I audible? Yeah. Good afternoon. Yeah. Yesterday we have discussed about, so far we have discussed in the last class, we have discussed about the financial management and introduction, and also financial planning and forecasting. So in the last class, we have discussed these two concepts. Now we are going to discussing about the time value of money. The time value of money is this is the one third unit under the first module, first block. Now, what is the time value of money? Time value of money is a fundamental financial concept that states that a sum of money today is worth more than the sum of money in the future. So simply, if you have money, you are going to diversify. You don't know how to invest money. If you're going to invest in different portfolios, the future, that is going to be changing the value of the existing. So today is, for example, February 1st. So next year, same, that value may be increasing or decreasing. So it depends upon our portfolio. So that is decided by the time value of money. So how much time we have hold our money into particular portfolio, particular investment. So that is going to be deciding about the particular value of the particular product. Now, the time value of money is a TVM, is a fundamental financial concept that states that a sum of money today is worth more than the same sum of in the future due to its potential earning capacity. This principle is crucial in investment decision making, capital budgeting, and financial planning. So the people are unable to take that proper decision making. They don't know because they don't know how to invest, where to invest, and why, what kind of portfolio are there to give more returns. So that will decide by the time value of money. Now here we have some concepts are there, that is the present value, future value, and discounting period. So what is present value? PV. We are going to simply we are mentioning that PV, present value. So the current value of a future sum of money discounted at a specific date. So today, how much the current value is there? So that is going to be how much there is going to be there in the future sum of money. So that we are going discounting maybe in terms of discounts, in terms of percentage. So in the case of future value, the amount of present sum of will grow over time with the interest or returns. So how much amount that is going to be increasing in the future. So that is going to be there known as future value. And discounting, the process of determining the present value of future sum. So discounting the process of determining how we are going to determining about the present value in the future sum of value, sum of amount, sum of investment, the future, that is known as future discounting. Now here compounding is there, NP is there, and perpetuity. So compounding, the process of calculating interest on both in the initial principal and accumulated interest. So for example, if I go invested money, 1 lakh rupees, you earn certain rate of interest, maybe 10%, 12% rate of interest is there. So even the next year, you're calculating this year interest plus existing principal. maybe for example 10%, maybe 10,000. You're going to calculating in the next year interest that may be 110%, 110% on the existing. So every year there is going to be adding 100% plus 10%, maybe next year 12%, like that. Every time that is going to be compounding the process of calculating interest on both the initial principal and accumulated interest. Annuities, a series of equal cash flows occurring at a regular intervals. Annuities means every quarterly, every half yearly, that is going to be occurring in regular intervals. Example, loan payments, pension payments, all these are the annuities. So they are going to giving some intervals, some break particular investments. And perpetuities, a stream of equal payments that continues indefinitely. So same amount was divided for long term. Long term, that is going to be, there is no change. Equal payments are going to be there. So that is known as the perpetuities. So all these are the points, key concepts of time value of money. So here another key components of time value is that the key components of time value is the present value. So present, we discussed about the present value. Now how to see that payment of current value of future sum of money given a specific discount rate formula. PV is equal to FE into 1 plus R power of N. That is PV is equal to present value, FE is equal to future value. R is called discount rate, nothing but interest rate. Interest rate maybe 10%, 12%, 5%, something what we are going to fixing or we're assuming future, that is going to be discounting rate. And N is good number of years, how many years we are going to investing money in a particular segment, how much we are going to getting, depends upon the rate of interest and the present investment, how much we are going to receive in the future. That is PV is equal to FE into 1 plus R power of N. Let's see the example. If you expect to receive 10,000 in 3 years, if you want to receive 10,000, how much you have to receive? So discount rate is but mean nothing but discount rate, nothing but interest rate. The present value is PV is equal to 10,000. 1 plus 1 is a constant. 0.5 we are going to considering into decimals, so that is a 5% is 0.5%. If there is a 10% is 0.1%, 15% is 0.15%, like that. Into power 3 years means T, that is N. N means nothing but number of years. So 10,000 into 1 plus of power of 0.5 power of 3 is equal to 10,000 into 1.517 is equal to 8,640 rupees you have to invest today. If you're going to investing, you have to get that you have to get the sum of 8,006 rupees you have to invest today. So this means 8,640 rupees is totally equivalent to the 10,000 received in next 3 years at a 5% discount rate. So simply when banks are offering 6%, 8%, 10%. So depends upon, you understand that if you want to receive 1 lakh rupees, now how much you have to invest today? So that is the present value. That is the present value. Now future value. Now, future value. The future value is the amount an investment will be grow over time with the compound interest. So with the compound interest, nothing but PV is equal to FE is equal to PV into 1 plus R power of N. So example, if you invest 5,000 rupees today at an annual interest rate 6% for 4 years, how much you're going to getting in the future. So simply 5,000, that is your present value, you are going to invest in 1 plus 1 is constant 0.6%. If you are going to receive the 6% rate of interest in the future, and for 4 years, 4 years, how much you are going to getting. So simply if you are going to investing 5,000 rupees today, you will grow 6,310 rupees in the 4 years at a 6% rate of interest. So here the present value is different to future value is different to. If you want to know the future value, how much you are going to getting, that is future value, how much you are going to receiving in the future. So that's the reason you have to invest today. How much you are going to investing, maybe 5,000, 10,000, 1 lakh rupees. It depends upon that you are going to receiving it. So that means you are going to getting 6,300 rupees, 310 rupees means 1,300 rupees. You are going to getting interest in the next 4 years. Now, discounting, compounding or discounting. So compounding process of growing an investment over a time by reinvesting earnings. So compounding nothing but is a process of growing an investment over time by reinvesting earnings. You're going to reinvesting money. For example, if you invested 10,000 rupees today, in the next year, how much you are going to receiving, that will be counted for second year. So every year that is going to be compounding for a generation. So every year, maybe for 10 years or 20 years, or depends upon that, that is going to be compounding, accumulating. But when it can come to the discounting, the process of determining a present value by reducing future earnings based upon the discount rate. So the process of determining the present value by reducing the future earnings. If you want to get future earnings, depends upon the discount rate, nothing but interest. How much you are going to receiving in the future, that is a discounting. Now, practical applications of time value of money. So let's see the loan calculations. Just you can look at here how to calculate the this thing. So loan calculations part, the helps to determine the EMI for car loans, home loans. So loan calculations are on practical. That means we used to get that investment interest money in the future. So loans are home loans are long term, maybe 10 years or 5 years, it depends upon the term. So that means we are going to receiving it. And investment decisions, calculating, evaluating stock market investments are retirement funds. So when you go into the retirement fundings, so investment decisions are very important to evaluate the stock market investments or retirement funds. So generally, if I want to receive in the future, that means how much you are going to investing. That is the important factor. And capital budgeting. So business use TVM to assess the viability of long-term So capital budget is nothing but a business use a time value of money to assess the viability of long-term projects. So long-term projects, the companies, how much they're going to getting. So they're going to knowing by applying some modern methods like net present value, internal rate of return, IRR, AI, accounting rate of return, ARR, probability index, and payback period, PBP. All these are the comes under the capital budgeting to know the all are the part of the time value of money. Savings and retirement planning helps individual estimate how much they need to save today for future needs. So here, how much we want to receive, that is the savings, retirement planning. Generally, people are going to saving money in the banks, maybe in the PPF or some other platforms. So they want to retirement insurance companies. So they also getting the retirement planning and the benefits. So all are the time value of money, particular time that will calculating for maybe 20 years or 15 years, depends upon that they are going to getting the value. And the time value of money, TVM, is a crucial financial principle that helps in making informed decisions about investments, loans, and savings. So if you're going to investing in particular organizations and institutions or any company, how much you are going to getting, how much you're going to receiving, the returns depends maybe in terms of percentage, 10%, 12%, even the time loans also. Banks also issue the loans to the public in terms of housing loan, in terms of car loan or some other personal loans. So they also charging certain percentage, maybe 10%, 12%, 8%, something depends upon the property and the size and value. And the savings, so people are also saving their money in terms of insurance companies, maybe in the banks, maybe in the stocks, maybe in the PPFs. So all these are the time. For time being, they're calculating the interest and they're receiving the interest also. So understanding how money grows or losses, that means the value over a time, it enables better financial planning and wealth management. So this is about the time value of money. Now we can see another concepts. Now you can see the black two, that is investment decisions. So investment decisions here again, 3 units are there. That is capital budgeting, investment evaluation techniques, and risk analysis in capital budgeting. 3 units are there. So now see the what is capital budgeting. Generally, first of all, when we come to the what is the overview of the investment decisions. Now overview of investment decisions. So investment decision is making a crucial financial process in which individuals, business, or institutions all allocate resources to different assets or projects to maximize returns while managing risks. So if they are going to taking any kind of resources, if they maximizing the returns, how much they are going to investing, that is the important point, the crucial point, that is the critical financial plan. So it involves evaluating various investment opportunities based upon the factors such as expected return, risk levels, market conditions, and the financial goals. So here it involves, there is a if you are going to evaluating that various investment opportunities based upon the factors such as expected return, risk levels, and market conditions and financial goals. Now, types of investment decisions. So, capital budgeted decisions, long-term investments. The concern with investing in assets that generate returns over an extended period, like machinery, infrastructure, R&D, business expansion. All these are the capital budgeting decisions. So, when you are going to see the capital budgeting is a long-term investment here, machinery. If you are going to purchasing for any company or industry, there is long-term infra R&D. It is a long term for business expansion. So that's the reason is concerned with investment in assets that generate return over an extended period. And methods used, which kind of I discussed about the methods, types of methods. We're going to calculating that investment decisions. We are going to calculate using the net present value, NPV, ARR, IRR, internal rate of return, payback period, PBP, and a profitability index. So these are the modern and latest tools or methods to calculate the investments. Now, working capital decisions, short-term investments. So managing short-term assets and liabilities to ensure liquidity and operational efficiency. So it involves a decision related to this, such as cash, accounts, receivable, inventory, and the short-term financing. So here, working capital decisions are managing short-term assets. For example, if we want to run the business, we have to manage minimum amount in our hand, that is the cash in hand, cash in bank, for liquidity purpose. So if any kind of salaries in kind of purchase immediately, we are going to making some expenditure on particular product developments or manufacturing. So it involves the decisions related to the cash, maybe accounts receivables, maybe inventory stock, or short-term financing. All these are the working capital decisions. Now, portfolio investment decision. So allocation of funds among different portfolios, financial instruments such as stocks, bonds, mutual funds, and real estate. So if you are going to investing, if you have 1 crore rupees in your hand, how much amount you have to invest in the stocks and the bonds and the mutual funds and the real estate. So you can look about all angle. You can see which sector or which criteria, which kind of instruments is providing the use returns and stable income, stable returns. So that means you must have a proper financial knowledge, and based upon that you must take the proper financial decisions. So it aims to balance the risk and the return. Yes, certainly. You don't put all amount in a particular stock or particular bond, particular mutual funds or some other real estate. So if you're going to investing, sometimes that may be locked. Sometimes that sector may be giving losses. So sometimes that sector may not give you proper appropriate results and not even average returns. Sometimes there may be pulled, but for long term. And there's a reason we have to segregate or allocate the funds in different portfolios. Maybe here I given only 4. You may have a number of platforms are there, a number of options are there to invest the money into different portfolios, because we are balancing the risk and the return. In the 2 categories are there too. One thing is that we are going to balancing the risk, and also we are going to getting the returns based upon the investment preferences. And replacement and expansion decisions. So replacement decisions, whether to replace an existing asset with a new one. So sometimes a company using the old machinery, or else uh, not no latest technology. So that we have to replacement. So for that we have to take the decisions whether to replace an existing asset with a new one. So how we are going to utilizing that, taking the replacing the particular decisions and the expansion decisions. So whether to invest in expanding production capacity or operations. So sometimes depends upon our manufacturing, we how to take the decision to expand our business opportunities. Now, what factors influencing investment decisions? What are the factors? Risk and return analysis. What is the risk here? High risk investment generally offers high potential returns. So high returns. So we have to see that high returns and high risk. High risk investment generally offer higher potential returns. So, and the second thing is that time value of money, TVM, the future value of cash flows consider while making investment decisions, and market conditions. So we can look about the market conditions, how the market is going to giving, marketing is stable in the market, how the market was there, economically stability, inflation stability, interest rates, and industry trends and impacting investment choices. So here the factors are influencing investment decisions. So what is that risk and return analysis? Time value of money, market conditions, and the cost of capital. So the required rate of return and on investment to make it profitable. So cost of capital, the required rate of return on investment to make it profitable. And government regulations, tax policies. So government depends upon always that is going to be uh, tax policies. The tax policies, legal framework, and incentives play a role in investment decisions. So the government regulations also will impact on the this investment criteria. So this is one kind of the investment decision making process. And liquidity considerations. So liquidity considerations, investment should um, align with an investor uh, liquidity needs and financial goals. So here the liquidity considerations are investment. Um, Simply we can always think about how liquidity is going to be increasing this thing. So investment should align with the investor's liquidity needs in the financial goals. And investment decision making process. What is the investment decision making process? So we have to identify the investment opportunities. What is that investment decision process? Identifying the investment opportunities. We have to identify the investment opportunities, and that means analyzing the potential investment avenues and evaluating investment options. So assessing the financial feasibility and the risks. So we have to assess the financial feasibility and the risks. That means we have to evaluate. and selecting the best investment. So how to know which kind of investment is giving more returns? So choosing that aligns with the goals and expected returns, and implementation, allocating funds and executing the investment. So we have to allocate the funds and executing the investment different plant portfolios, or else decision making process. So that means for that we have to take the implementation and monitoring and review. So periodically reviewing the performance and making adjustment periodically. We have to review every time, every day, every week. We have to review that periodically, and the performance and the making judgments. And investment decisions are crucial for wealth creation, business growth, and financial stability. So a well-structured investment strategy helps in maximizing returns while minimizing the risks. So for that, must have a proper financial knowledge and financial decision power. So, and we must understand that my marketing, market, uh, business market, and what are the um, uh, gaps are there in the business. So that kind of marketing gaps we must understand, and we must now reduce the risk and maximize our profits, returns. So proper analysis, risk assessment, and strategic planning ensure successful investment outcomes. So proper analysis is important. So here everything there must be a sustainable and systematically we have to analyze about the risk assessment and strategic planning. And another entity is there here, that is in this financial management block 2, that is capital budgeting. So what is capital budgeting? Now we can see the capital budgeting is the process of evaluating and selecting the long-term investment projects. So capital budgeting deals with always we discuss about the net present value, profitability index, internal rate of return, and payback periods. All are we are calculating for the long-term budgeting process to evaluating and selecting the long-term investment projects that aligns with a company's strategic goals. So how what is the strategical part is there? How the persons are investing money, how much they are receiving the money. So we can see about the financial assessment of capital budgeting. Now, importance of capital budgeting. So, importance of capital budgeting, about 5 things are there. Here, it helps in business allocating the resources. Every year question, what is the expect initially? If that in the initial stage, they want certain money in after 2 years or 5 years or 6 years. So, are you able to see how that investments are going to be equally viable, and reducing the risk of financial losses, and supports long-term strategic planning, and enables the shareholders value. Why we are discussing about all these things here? Here, there is a one kind of systematic approach is there. So there used to see a lot of gaps are there in the business. So these are the steps are there in the capital budgeting. So what is that the steps? First step is that we have to identify the investment opportunities. Where, why, how to invest? That is, we have to find the potential projects. That projects are there. Where are there? That project where maybe new factory or R&D company expansion. All these are the opportunities, new investment opportunities. We have to identify that thing and evaluating the investment proposals. So using financial techniques like net present value (NPV), internal rate of return (IRR), and payback period payback (PBP), and profitability index. All are the evaluating investment proposals for the long-term process in the capital budgeting. Selecting the best investment, choosing project that maximize returns while managing the risks. So investmenting the investment. So allocating funds and acquiring assets and beginning operations and monitoring the revenue, reviewing the performance. So comparing actual versus expected results and making adjustments. So we have to select the best investment among the 5 or 10 or something, and we have to implement the investment. So we have to rigorously, continuously, we have to investment our particular project, and also monitoring and reviewing performance. So every company is generally operating doing businesses, but sometimes they used to monitor the front end. Sometimes the people are going to be there in the back end. They can also look about the financial performance and from the top front end or top end. The people results output is an important factor. And the capital budgeting techniques. So we have discussed about the techniques that is traditional or non-discounted methods. So payback period is the time taken to recover the initial investment. How much time is there to receive our money? That is known as payback period. And accounting rate of return (ARR), their profitability based upon the accounting income. So profitability, how much that is going to be there, how much that must be accountable for each and every batch, and discounting cash flow and methods. So discounted cash flows DCF methods. So net present value (NPV), the present value of future uh, now traditional. There is only two: payback period and account rate of return. But when come to the discounted cash flows, the above two are the non-discount. That is payback period and ARR, account rate of return. When come to the discounted cash flows, NPV, net present value, internal rate of return (IRR), and a profitability index. So all these two five are comes under cap, which is techniques. But here they divide two categories. That is present value, another one is future value. So the future value, So here the types of capital budget decisions: the expansion decisions, replacement decisions, and mutual exclusive decisions, and mutual exclusive decisions and independent decisions. So independent decisions and contingent decisions. So we are going to we're going to taking the decisions. We have to expand the decisions and replace the decisions and mutual exclusive decisions and the independent decisions. So, and capital budgeting is essential for a business to make informed long-term investment decisions. Using the financial evaluation techniques helps ensure that the capital is allocated to project that maximize the value, that minimizing the risk. So that's the reason we are utilizing the capital budgeting techniques by using the modern and discounted, non-discounted methods. That is net present value, internal rate of return, profitability index, and accounting rate of return, and also internal rate of return and net present value. So payback periods, all these are the important techniques to know the evaluating the capital budgeting. So in the coming next class, maybe next week, we will discuss about the risk analysis and capital budgeting. So in the next class, we will discuss about these concepts. Like this, I'm winding up here. So tomorrow class, in the next class, we are going to knowing of the investment evaluation techniques and risk analysis in capital budgeting. So with this, I'm stopping here. Thank you.